All right, so chapter 8 focuses on receivables, mostly accounts receivable, and a little bit of a deeper look into notes receivable. And it breaks it up into basically two parts: how things are reported, because receivables are on the balance sheet, so there's things to note about them. And then it ends with how to analyze receivables. And there's two little new pieces of ratios that we're going to be looking at, how to analyze. Okay, so the first objective is pretty basic, sort of explains things that you probably have seen before. So probably not a lot of new stuff here. More of it will be as we go through. So let's just start off with a nice review on receivables. Now remember what an accounts receivable is, right? An accounts receivable is basically you've already done the work for the customer, or you have already sold the customer goods, right? And you have agreed to receive payment later, usually in 30 days. And that's basically how an accounts receivable is born. Now, you and I can't usually get away with this as individuals. We can't walk into, Walmart, grab a bunch of stuff and say, okay, I'll pay you in 30 days. I mean, they're gonna, they'll have the fish kill police on your tail quickly. Um, but businesses do this with other businesses. Okay, so it is very common that business relationships get established, and part of that relationship evolves into, okay, I'm going to sell you stuff and you can pay me in 30 days. We'll give you a bill. So that's normally how that happens. And this is the crux of this chapter, is most on accounts receivable. The other thing that you'll be introduced a little bit more is the notes receivable. They're also called a trade receivables because they're often created from accounts receivable. So remember, accounts receivable, you're waiting to receive the money in 30 days from a business client. However, sometimes they need more than 30 days to pay. And so what businesses do is they'll say, look, I'm willing to give you 60 days, 90 days, 120 days. I mean, usually they're in monthly intervals or in periods of 30 days. I'm willing to give you a longer period of time, say 90 days. And in exchange for giving you that longer period of time, we're going to charge you interest, and you're going to sign that this is the deal. And that's a note receivable. So that's how most notes receivables are born, in that exact way. So learning objective 3 talks a little bit about notes receivable, and we're going to look at that briefly. What we're not going to talk about are the fact that companies have lots of other receivables on their books. As you get deeper into accounting, you will learn things, lots of other accounts that exist in the receivable area, such as interest receivable or income tax refundables that they're waiting to receive. A lot of corporations give loans to their officers or advances to um, employees or management, and they're waiting to receive payment back on that. So there's lots of other receivables that a company might have, but we're not going to be focusing on that. Again, the biggest part of the chapter is accounts receivable and a little bit on notes receivable. Okay. So receivables can be a very sizable part of a company's assets. So receivables as a percentage of assets, you'll notice, and I'm going to pick on Ford because I don't know how long ago this chart was done, and GE has changed quite a bit over the last several years. It's a much smaller, different type of company than it was before. So I'm going to pick on Ford for a second here because this is very typical. Ford Motor Company has, of all of their assets, think about that, from all of the assets that this company has, and they have a lot of assets, 43% of the assets are receivables. That seems like an incredibly huge number, and it is. And it's just basically the nature of the industry. The automotive industry is structured it's an old-fashioned push system, and what I mean by that is Ford Motor Company manufactures, cars and trucks and SUVs and things like that. They sell those to regional distributors, and regional distributors they don't pay cash for all of that delivery. So thus, Ford Motor Company has a receivable with the distributor. The distributor then turns around and sells the cars and trucks and SUVs to the individual dealers that you and I might visit to buy a new car or something like that. And of course, those dealers don't pay cash for those cars usually either. So they'll also have quite an amount of money that they'll owe the distributor in receivables, which again, the distributor owes Ford Motor Company, the manufacturer. So that's just the way this particular industry is sort of structured, and it explains why they have such a large part of their assets in receivables. So receivables are recognized when you either perform a service on account, if you're a service organization, or you sell merchandise on account, if you are a merchandiser. And basically, again, you would normally do this for other business customers. It would be very unlikely to do this for folks like you and me. But anything that is sold on account basically sets up a receivable for the business who sold it. Okay. And of course, the seller wants to collect that, because what accounts receivable will be is cash eventually, right? 30 days. So the seller might offer, an incentive to pay early and collect the cash early by saying, look, if you pay me in 10 days, take a 2% discount, right? The buyer might be very enticed by that. And of course, the buyer might also return goods to the merchandiser. And that means that the receivables are going to be changed on that account. Because if the buyer returns goods to a merchandiser, the merchandiser isn't going to be receiving any money for that. So they'll have to update their receivables accordingly. And we've seen this from chapter 5 when we looked at merchandising companies. So this is going to ring a bell pretty easily. So here we have Jordache Company on the 1st of July, 2017. They sold merchandise on account to Polo Company for $1,000, 210 net 30. So preparing the journal entry for Jordache would show that since we sold it on account, we're going to set up an accounts receivable, debit to accounts receivable, credit to sales revenue. Of course, after this, we would also put the cost of goods sold and credit inventory, but it doesn't say that on this slide. But I figured I'd add that in. Again, returns are just part of life in a merchandising company. And here, Polo returned $100 worth of stuff. And so they're going to need to debit sales returns and allowances, but look where they credit. They take that away from receivables, so receivables would be changed by this as well. And then, of course, when it does come time to pay, if they pay within that 10-day period, they're not going to be collecting every single penny of receivable, right? Because they've given a discount. So in this case, they say that they no longer have $900 of receivables, but that $900 of receivables only turned into $882 of cash, all right, because they provided an $18 sales discount for early payment. And this is an insight for you in terms of what happens to receivables. Just because a company has $900 of receivables on the books, the question is it really worth $900? Right. Well, no. A couple of things can happen. This is one of the things that can happen is there could be discounts involved, so that $900 ends up being only $882, right? And of course, it's quite possible that this other company, of course, could have been affected by the coronavirus and gone out of business and unable to pay. So a lot of things can happen with receivables, making it a very interesting account to get to know more about. Some come, and this is before, I think this is sort of a relic type of an example here, but I'll review it with you. Um, because a lot of retailers in the past used to have their own credit cards. Now, what's typical is they will basically outsource that function to a bank who specializes in retail cards instead of having their own retail card. And but this is how it worked. Let's say if you were using a JCPenney card at one of the remaining JCPenney's that might be open, and you bought clothing for $300. Of course, in this case, JCPenney would show that as a receivable if it's their own credit card. Okay, if it's not issued by a bank. So if their own credit card, they would show that as a receivable. Okay. Um, And then, of course, retail cards charge outrageous interest. We're lucky here that it's only 1.5% per month, which is 18% per year. Most retail cards are higher than that. And so not only do you owe the $300 at the end of the month, but you also probably owe the interest on that. And so JCPenney would have to, in this case, increase their accounts receivable by the 450, which is the interest on the balance. But the interest is not accounts receivable; it is interest revenue. Anytime a company is making money this way by giving a loan, in essence, they have to record the interest as revenue. Okay, but again, the accounts receivable um, has changed. So there's a lot going on. You've seen a lot of frauds last chapter, so I'm not going to really kind of get much going here. But this person was an accounts receivable clerk for a nonprofit foundation. Um, and she had lots of duties that gave her lots of different control over things. She was supposed to get checked with of her work. Her work had to be sort of approved by her boss, who was the company controller. But the boss only did a very superficial review of her work, particularly when it came to the bank reconciliation. So this person made this charity into her own, or his own. I'm not really sure. Sorry, her own, and grabbed $1.5 million, which is pretty impressive grab over time. Segregation of duties was not present because she was allowed to handle cash, to record the cash, to make deposits, and prepare a bank reconciliation. So she sort of knew all that stuff with cash. No one else did. Her boss just didn't really do his job well. And of course, they were also cited to the fact that the controller, who was supposed to be the way they verified these things, didn't do his job. So he was fired as well. So very important, very, very important stuff. So that's do it exercise. This learning objective one, do it exercise one is just basically um, a review of those receivables. Here we have, Wilton sold merchandise on accounts to Bates. So on May the 1st, you have an accounts receivable and a debit and a credit to revenue. There's a return of merchandise on the 4th. So sales returns and allowances is debited, but look, the receivable is credited, so it's changed. We're not going to be receiving that money on any returns. And then there was a 3% discount. The terms were 3% discount on the balance, and so even though they had a $48,000 receivable, it only turned into $46,560 of cash in value because they had given a pretty large discount. Okay. So that's our intro to this. Any questions?